2023 is here. Have you taken the time to update your dream board? I don't know about you, but 2022 flew by. The beginning of the year is always a good time to reflect on the previous year and also prepare for the year ahead. If you don't spend the time now to game plan for the year ahead, when will you? You could be missing out on some important changes that could affect you down the road and in your golden years of retirement. Waiting to prioritize these changes can lead to forgetting about them or not having enough time to implement the strategy you otherwise would have. I'm Jacob Harkey, Wealth Advisor at Sweet Financial Partners located in southern Minnesota. We specialize in all-encompassing financial planning, and a huge part of that is creating a retirement beyond wealth. One of the most crucial ways to achieve this is through thought-out tax planning. Here at Sweet Financial Partners, we have taken hundreds of clients through our trademarked Dream Architect process. Through each of these plans, we can account for important changes, but there are things that you should be aware of that you can take action on your own. For example, taking the first step to set financial goals. It's important to identify what you want to achieve with your money in the short term and the long term. This can help you prioritize spending and making better financial decisions. In fact, we believe everybody should be thinking about retirement like this. Our founder, Brian Sweet, and President Brittany Anderson wrote the book, Dream Architecture, which was created to define what retirement beyond wealth truly means, capturing the essence of total fulfillment and joy. Grab your free copy at dreamarchitecturebook.com. So let's meet David. He had worked for the same employer his whole career. As he approached his 60s, retirement was on the horizon, and he realized he had not saved enough money to retire comfortably. In fact, he had not prioritized investing until he was even in his 40s. And then he had not been consistent with his contributions. David had always been so focused on his work and didn't pay much attention to his finances. He had assumed that his job would provide for him a comfortable retirement, but as he approached his 60s, he realized that was not the case. He had only a small amount saved up in his company 401k plan and had no other outside retirement savings. This is when he sought out our help. We were determined to help him achieve his retirement dreams. We worked closely with David to create a plan that would help him make up for lost time. He started paying closer attention to his finances, cutting back on some unnecessary expenses, and putting more money away for retirement. It was a challenging journey, but with perseverance and commitment, he saw his retirement savings starting to grow. David's story is a perfect example that it's never too late to start planning for the next chapter in life, but it's also a cautionary tale that the earlier you start planning, the more time you have to make any needed changes and see the effects compound. Retirement is a time for enjoying the fruits of your labor, and with proper planning, it's possible to live comfortably through the next chapter in life. So in the beginning of the year, it's a good time to review your goals and dreams, both in the long term and the short term. When it comes to creating a financial plan, many people skip this critical step of dream or goal setting. It can be easy to dismiss this as woo-woo, but in reality, it is the essence of the process. Dreaming helps to create a detailed plan for your future, not only in the financial sense, but also in the sense of fulfillment. Personally, I've always dreamed of building my own home. This dream seemed far-fetched, but it gave me something to work towards and helped me plan for my future accordingly. After I was able to achieve this, I shifted my thoughts and started dreaming more about traveling and taking my girls with me, not just as an experience for me, but also to be able to witness the world through their little eyes. I have found that having clear goals and dreams has helped me stay focused and motivated. For clients, I have seen many examples of dreamers and goal setters. I once worked with a client who dreamed of using their retirement to give back to their community. They spent their working years focused on their career and family, but they had always felt a deep desire to make a difference in the world. To achieve this goal, we worked together to create a plan that included volunteering opportunities, philanthropic ventures, and even starting a nonprofit of their own. We also discussed how to ensure that they had the financial means to support these efforts. Through their dedication and hard work, my client was able to achieve their dream and making a positive impact in the community during their retirement. They also were able to find a sense of purpose and fulfillment that they had been missing for years. And it was incredibly rewarding to see them achieve these goals. Dreaming and goal setting can provide a foundation for a successful future. It gives us something to strive for and a roadmap for getting there. And you may be surprised at how it transforms your life. Just some important updates for 2023. There were some contribution limits passed by the government. The IRA and Roth IRA contribution limits to increase to $6,500 each. So anyone with earned income up to certain limits can make these contributions. And if you're over the age of 50, you can also contribute an extra $1,000 for a catch-up contribution. Again, you have to have earned income in order to make these contributions. And there are some certain income levels that kind of change your abilities to make these contributions as well. So if you're over the age of 50 and within the income limits, you can contribute up to $7,500 into an IRA or Roth IRA. Another important change for 2023 that will take effect in 2024 is that catch-up limit I just mentioned is set to adjust for inflation. So $1,000 has been the limit for 15 plus years now. Going forward, it's going to be adjusted for inflation each year starting in 2024. 401k and 403bs or other such employer-sponsored retirement plans also saw increases. Anyone that is eligible and has enough income can contribute up to $22,500 to such retirement plans. And these also saw an increase in their catch-up if you're over the age of 50 to $7,500. So if you're employed and have one of these plans, you can contribute up to $30,000 if you're over the age of 50 starting in 2023. Other work-related plans like simple IRAs and SEP IRAs also saw increased contribution limits. So if you may be eligible for one of those, I'd recommend you talk with your financial advisor about that. Health savings plans also saw increases for 2023. With an individual that has a high deductible health plan, they're able to contribute $3,850, whereas a family also covered by a high deductible health plan can contribute $7,750. These could potentially be tax deductible and grow tax free. Similar to IRAs and Roth IRAs, these accounts also have a catch-up limit, but they come into play when you're 55 years or older. This, however, did not increase and is still at $1,000. So again, if you're an individual covered by a high deductible health plan and over the age of 55, you can contribute $4,850. Whereas if you're a family and over the age of 55, you can contribute $8,750 for 2023. So why is this important? If you're nearing retirement, now might be the time to start stuffing additional funds away to help you achieve your perfect retirement. As you may be approaching retirement, it is a good time to start thinking about what the next phase of life looks like. Once you have that vision in mind, it's time to start thinking about the financial piece and how you are going to be able to achieve that. How we do this at Sweet Financial is taking you through our trademark dream architect process. From there, we can decide what strategies will work best for you. If you aren't quite ready to start thinking about retirement just yet, it's important to know that there are limits to some of these things and they do change from year to year. One general rule of thumb that we recommend to clients is to make your contributions go up by another percent every year. So say you're contributing 5% this year, you should contribute 6% next year. It's just kind of a steady increase to help get more money put into your retirement savings. This may seem like a small thing at the time, but through compounding and years of continued success, it'll pay dividends in the end. The beginning of the year is always a good time to start with this, and I would bet you don't even notice the extra little income coming out of your paycheck each time. There are also some important tax changes to be aware of for 2023. The standard deduction has gone up, and also paired with inflation, there are higher thresholds to each of the current tax brackets. So for the first time, actually in the history of the tax law, if you're over the age of 65, the standard deduction has increased to $30,000. Actually, it's $30,700 to be exact. But the standard deduction for everybody, just the normal standard deduction, has jumped up to $27,700 for a couple married filing joint, and $13,850 for single filers. And then again, if you're over the age of 65, you get a little bit extra. So you get $1,500 for yourself and $1,500 for your spouse, getting you to that total of $30,700 if you're over the age of 65, or if both you and your spouse are over the age of 65. This will make it harder for individuals to itemize their deductions. And if you're used to itemizing, you may no longer be able to do this. So some things to consider are bunching your deductions every other year. So you can itemize one year, take the standard the next year. Also, the top of each tax bracket has also increased. So pairing the larger standard deduction with the higher limit on your tax bracket may mean that you have some additional income this year that would have been taxed at a higher rate last year. This is important because tax rates will be going up in the future. If you have additional room in your current tax bracket, thanks to the increased standard deduction and higher tax brackets, then you might want to consider doing some Roth conversions. I can tell you a time will come when you will need a lump sum out of your retirement accounts And having some funds in a Roth IRA will help reduce that tax burden so it won't hurt so much. So a Roth conversion can help you divide that tax burden over many years instead of taking it all at once. And doing so in 2023, you will likely be in a lower tax bracket now than you are in retirement. Take, for example, the 22% tax bracket for a married couple. You can have up to $190,750 of taxable income. That's after the standard deduction, and be in the 22% tax bracket. But let's say after these rates sunset in 2026, that same $190,750 will be taxed at a rate of 28%. So you can see right now there is a little bit less tax rates than there will be in the future. The Secure Act 2.0 was also passed at the end of 2022 with some important changes. Probably the hot topic item with this is the required minimum distribution, or RMD age, was once again bumped back. So now starting at age 73, you have to start taking money out of these retirement accounts. It used to be 72, not the case anymore. You got another year for some additional tax planning. The law also pushed futures starting ages to 75 by the year of 2033. One important strategy that is tied to required minimum distributions is qualified charitable distributions, which were not changed. You can still start making these at age 70 and a half. So if you were charitably inclined and you give funds directly from your IRA to charity, they will not be considered taxable income. Remember the increased standard deduction. This is one way you can still get a tax benefit for any charitable contributions. Bumping the age back to 73 and eventually 75 allows you some extra time and extra control for your income to decide how much you want to take from retirement accounts before you're required to take a certain amount. There are also some other important Roth-related changes that were passed with the Secure Act 2.0. Roth Simple IRAs and Roth SEP IRAs were also made available. Prior to this, small employer plans only allowed tax deferral plans. This is another way you can take advantage of current tax laws and get some additional money put into some Roth accounts where funds will grow tax-free, where maybe you weren't able to do that before. Again, see the example I gave before about the changes in future tax rates and having a choice now where to set up future funds. Another Roth topic that was created allows for 529 plans to shift funds into a Roth IRA. There are some specific criteria that need to be met, but this allows you to move any unused 529 money into a Roth IRA for plan beneficiaries. You could say something like, not everyone is wired to think about dreaming or aspirations for the future. It doesn't have to be difficult or just the warm fuzzy stuff. It can actually be done through a detailed process. So tune into Balancing Your Dreams and Work that Amber Knips, another wealth advisor in our office, put together.